Hi there, this is Robin, your Inclusive Business Resource Network Capital Advisor, and welcome back to our Startup Capital video series. This is video number 4, and we'll talk about debt capital today. As a reminder, debt capital involves capital that is, provided to a business with the expectation that that capital is returned to the lender, typically with, some interest. And that there's no expectation for ownership or control in the business, and there is no expectations for profits or proceeds if and when the business is sold. So it is a different type of capital from equity capital. This will probably be the longest video because most businesses or small businesses that get capital, they get it in the form of debt. And so we'll dive a little bit deeper in this type of capital. So let's first talk about two different types, the typical types of debt. There are term loans. Term loans are loans that are made to a business or to an individual where there is, upfront cash to make a purchase, and that you have monthly repayments or you have repayments of that loan over time. So, for example, a mortgage, all right, you get a lump of cash upfront to buy a place and you make monthly payments for 15, 30 years until the mortgage is paid. Same thing with auto loans. You get a lump of cash up front that you can use to purchase a vehicle, and then you pay for it using monthly payments, over the course of anywhere from 2 to 7 years as a typical term. So that's referred to as a term loan. There are also lines of credits, and lines of credits are a little bit different because they provide access to capital, a set amount of capital, and you draw funds when needed. And so when you draw the funds that are needed, there is a minimum monthly payment on the outstanding capital. Typically, it's the interest, and sometimes it's a little bit of the principal. It depends from the type of line of credit, but there is typically an expectation that you pay back a little bit of the line of credit. And then at some point at the end, some lines of credits end, let's say after 2 years, and they expect the balance to be paid at that point. Or they're automatically at that point converted to a term loan where you have a fixed monthly payment that you pay off over time. So examples of a line of credit include credit cards. Very typical example. Your available credit is set on the credit card. You can draw to that amount and you pay it back, either entirely at the end of the month, every month, or you pay down a portion every month and until it's paid off. There's also home equity lines of credits for those of you that may own a home. You may have equity in your home, and you get a home equity line of credit to tap into that equity if you need it, and then you draw money from it, and again, you make monthly payments to repay that loan over time. So, typically for most startup businesses, the type of debt that they get is personal debt. And so, what that means is that the owner takes out the loan in their personal name. It's not in the business name. The amount that's offered is based upon the household, not the business income. So, if you have a partner in your household that is earning money, and some of your partner's income, including your income, the household income as a whole, can be used to determine if you can afford a personal loan or used to determine, how big of a personal loan you can get. Once you're able to secure those the funds are then invested or loaned to your business from you, the owner, to the business. And then the monthly payments that are due on the loan are the responsibility of the owner, not the business. But the expectation is that the business would ultimately generate enough profits so that it repays you, the owner, which you can then use to repay the personal loan. So you make some type of arrangement between you, the owner, and your business to repay the loan. And types of personal loans include a personal bank loan. You can go to your bank. If you have a good standing with them, they may be willing to offer you a relatively small loan just for being a good client with them. Credit cards, even though they're a revolving loan, it is a form of, a line of credit. It is a form of debt that a lot of people have access to. and you can take money out from a credit card either by purchasing. So, you might be purchasing inventory and supplies with your credit card and making that available to your business. Or you can draw cash from your credit card, though understand that there's often some fees and expenses and sometimes quite expensive to support those type of draws. There's home equity loans that you can draw. There's also loans that you can draw from your 401k savings. It is a little risky to do that, and that is kind of beyond the topic of this video. But one of the things that I offer through the IBR network are capital advising sessions. And if you're interested in drawing capital from your 401k as a loan, we can talk about more individually, kind of one-on-one. The other type of debt is business debt, and this is where the business takes out the loan. Um, and the amount that is offered is typically based upon the business's income. And because it's based upon the business's income, it is almost impossible for startup businesses, businesses that don't have any revenue, to get a business loan. It's just because you are not generating any profits to repay the loan. If you're able to secure a business loan, the monthly payments are the responsibility of the business to make to the lender. However, every single business loan will require a personal guarantee, which means that if the business defaults or not able to make the loan payments, the owner or owners are personally responsible for making the payments. If you want a business loan without a personal guarantee, don't waste your time. There are virtually no lenders that will be willing to offer a loan without a personal guarantee. And some business lenders, typical business lenders, include banks and credit unions. There's also kind of niche or private lenders. They're often industry specific. They're well known in the industry. They know the industry inside and out. And they typically don't advertise, or you kind of have to learn about them through word of mouth. So these are private lenders. There are community lenders. These are typically nonprofit lenders that are available for mission-driven or economic development purposes, and I'll talk about them more later in this video. And then there are also online lenders that are out there, and I will talk about them also in a little bit later in this video. So I mentioned a couple times about community lenders. These are typically nonprofit or government lenders. In the Portland area, some of the typical nonprofit lenders include Craft 3, MISO, Mercy Corps Northwest, and Business Impact Northwest, to name a few. From a government agency perspective, Prosper Portland offers some business loans, as well as Business Oregon at a state level. The purpose of these lenders is not to generate a profit. If you go to a bank or credit union, often the purpose of the lending is to make a profit. But for these lenders, profit is not the motivation. The motivation is for a mission-driven perspective, for economic development or economic justice perspectives. As a community lender, they have much more flexible capital that is often not regulated, which allows them to offer much more flexible underwriting terms, which means that they can be more creative in deploying capital to businesses, and have much more flexible or can have much more flexible terms to the loans. These lenders are still not likely to lend to startups for the reason I explained earlier. They want to see a profit, they want to see proven management, but some exceptions do exist. There may be lending programs that are specific to certain industries or certain experience. If you are a baker and you've been a baker for 20 years, and you want to start your own bakery, just the fact that you've been in the industry and have that experience for such a long time, some lenders may be willing to extend that business loan to you. Those that do offer startup loans, they may require certain training, that you participate in some training before you get the loan. And once you get the loan, you might have to meet periodically with a business advisor or participate in certain training to make sure that you have the skills to operate your business and ultimately repay the loan. These type of startup community lenders do change a lot. There's, different programs that, start and go all the time. The funding to these programs is sometimes limited. So check with your capital advisor if you're interested in one of these loans to see, what may be available at the time of your need. The other type of loans, these are loans that you often see. You can get a loan in 48 hours. They're often referred to as online lenders. They exist, they're out there. They can be a viable source of capital for startup businesses, but I would offer many words of caution. Um, these loans, they often have a very simple, streamlined application process. There's no form, there's no, financial records to submit. The information that request is very simple. It's a very slick, easy 5-10 minute application process, compared to a very extensive application process that might be required by a more traditional lender. Um, the way they are able to offer these loans is that they have a very, very different lending model than your typical bank or credit unions. Most banks and credit unions, they're only willing to lend to businesses that they expect to be able to repay their loan. However, for these 48-hour loans, they expect their business model accepts the fact that some of these loans, or maybe even a good portion of these loans, will fail. And the way they justify it is that the loans are extremely expensive. Your typical, business loan interest rate is, anywhere from 5 to 15%. It can vary depending on the prevailing, interest rates in the market. But, 5 to 10, 15% is, within range, typically in the high single digits. I've seen these 48-hour loans when you add in the fees and all the other elements of the repayment plan to basically charge a effective interest rate of 75% or more. So that means that if get a $10,000 loan that's supposed to last 1 year, you expect to pay $10,000, returning the capital to them, but then on top of that, an additional $7,500 in interest fees within that first year. So very, very expensive capital compared to more conventional loans. The other thing is the repayment terms. Um, they tend to favor the lender over the borrower. With a typical bank loan, you get, they say make a payment once a month. It helps you manage your cash flow. Some of these online lenders, they require a payment every day. In fact, they'll even go into your bank account every day and pull out money to make the loan repayments. And while they'll say it's only $20 a day, and it might seem innocuous or easy to do, $20 a day for every business day does add up, and can be particularly challenging, especially if you're in your slow season. So there are many other. That's one example. There are many other kind of more onerous payment terms that these loans come with. And they can create a challenge for the business owners and easily put the loan in a default state, which then they'll charge more fees or apply legal pressure for you to return the loan. So while these loans are very tempting, be very wary. Definitely read the fine print, and if you don't understand the fine print, talk to someone that can explain the fine print to you. Do some modeling around the repayment schedules. Best case, worst case, average case. See how your business is able to fare under the terms of the loan. And also, once you go down the rabbit hole with some of these loans, it can be very difficult to get out. I've seen a lot of businesses get one of these loans. They then, they do well for a while, but then they struggle and they say, oh, I'll get another one of these loans because it was so easy last time to repay this loan and get a little bit more capital. And that cycle repeats itself a couple of times. All of a sudden, you have a very big loan that is, largely due to the expensive fees and interest that they charge. And so for that reason, it can be very difficult to get out of these loans. So that's it for debt capital. One of the things that we'll talk about in the next video is that if you have any questions specifically around debt capital, you can learn about how you can sign up for a free capital advising session and discuss, your specific loan or debt capital needs and see, what might be available to you. And thanks again to Prosper Portland for making these series of videos available.